Hello, everyone, and welcome to this episode. Today, we will be discussing the Black Monday stock market crash in the United States, which occurred on October 19, 1987. This event is regarded as one of the most impactful in financial history, with the Dow Jones Industrial Average, DJIA, plunging 22.6% in a single day, the largest single-day percentage drop ever recorded. The crash's effects were not confined to the U.S., as it quickly spread to global financial markets, causing significant long-term impacts on stock markets, economies, and financial systems worldwide. The Black Monday crash was not triggered by a single event, but rather by a combination of factors. Below are some key contributing causes and the market backdrop leading up to the event. Excessive stock market growth before Black Monday. The U.S. stock market experienced a prolonged upward trend during the 1980s. Between 1982 and 1987, the DJIA surged by over 200%, creating an overheated market where investor sentiment was overly optimistic and stock valuations increasingly disconnected from underlying fundamentals. The market exhibited clear signs of a bubble. The rise of program trading in the mid-1980s, the advent of computer technology led to the rise of program trading on Wall Street. Program trading involved using computer algorithms to automate large-scale stock trading based on market price fluctuations. This strategy amplified market movements by automatically executing large sell orders when prices started to fall, accelerating the market's decline. During Black Monday, program trading played a key role in exacerbating the crash, primarily due to the following reasons. As the market began to drop, the algorithms triggered further sell orders, intensifying the decline. There was a lack of liquidity. On the day of the crash, there were few buyers to absorb the large sell orders, causing stock prices to plummet even faster. Program trading systems were poorly designed to handle extreme market conditions, worsening market volatility. The impact of derivatives and index futures in the 1980s saw the increasing use of derivatives like stock index futures, which allowed investors to make large leveraged bets on the market. Speculators and hedgers used these financial instruments, and in times of heightened volatility, they contributed to the market's vulnerability. Rising interest rates and tightening monetary policy in 1987. The Federal Reserve adopted a relatively tight monetary policy in response to inflation concerns, raising interest rates. Higher rates negatively affected the stock market by lowering corporate profit expectations and increasing borrowing costs. The market's overreaction to interest rate hikes contributed to panic selling. Geopolitical and global economic uncertainty in 1987. Global geopolitical and economic conditions were unstable. Trade tensions between the U.S. and key partners like Japan and Germany were escalating, leading to uncertainty about global economic growth. Additionally, the U.S. dollar was experiencing significant fluctuations, further unsettling market sentiment. Against this backdrop, the stock market showed increasing volatility in early October. From October 14th to 16th, the DJIA dropped nearly 10% over 3 consecutive trading days, sparking panic among investors who feared it was the precursor to a larger crash. When trading began on October 19th, the wave of selling became unstoppable. As stock prices continued to plummet, program trading systems automatically triggered massive sell orders, accelerating the market's collapse. By the end of the day, the DJIA had plunged 508 points, or 22.6%, marking the largest one-day percentage drop in history. The shock of Black Monday quickly spread to global financial markets. As the world's markets became increasingly interconnected, the U.S. stock market crash triggered a chain reaction, leading to a worldwide financial crisis. The global impact was severe, with significant losses in stock markets across various countries. London stock market. The FTSE 100 index fell 10.8% on October 19th and continued to drop, with losses exceeding 26% by late October. Hong Kong stock market. The Hang Seng Index fell 45.8% in the days following October 19th. The Hong Kong stock market even suspended trading on October 20th to prevent further panic, but this only intensified market volatility. Japanese stock market. The Nikkei index dropped around 15% in the 2 days following Black Monday, entering a long-term correction phase. The stock market crash caused massive capital losses for financial institutions, particularly investment banks and hedge funds using high leverage. The exposure of these institutions heightened market panic, leading to a severe liquidity crunch in money markets. Black Monday also negatively impacted corporate investment decisions and consumer confidence, as the stock market's collapse reduced firms' ability to raise capital and dimmed their future profit expectations. Consumers, shaken by the stock market's volatility, reduced their spending, putting downward pressure on overall economic activity. The stock market crash also caused turmoil in the foreign exchange and bond markets. The U.S. dollar fluctuated sharply, and investors' expectations for capital flows became unstable. Meanwhile, bonds benefited from the stock market's turbulence, as some investors shifted funds from stocks to bonds, pushing bond prices higher. In response to the global financial crisis triggered by Black Monday, governments and central banks worldwide took swift action to stabilize the markets. Intervention by the Federal Reserve quickly stepped in to stabilize the market. Federal Reserve Chairman Alan Greenspan stated that the Fed was prepared to provide sufficient liquidity to the banking system to prevent systemic risks from spreading. This statement helped to ease market panic. The Fed subsequently injected large amounts of liquidity into the market through interest rate cuts and other measures, stabilizing the money markets. The Fed also coordinated with the banking system to ensure the smooth functioning of the markets and prevent financial institutions from collapsing due to liquidity shortages. Responses from other countries' central banks in major economies followed the Fed's lead by providing liquidity support and taking measures to stabilize exchange rates and market sentiment. Central banks in Europe and Japan intervened in foreign exchange and bond markets to try to reduce market turbulence after panic selling began. Market regulation and risk control reforms Black Monday exposed the risks associated with the over-reliance on program trading, leverage trading, and other emerging financial tools. In response, the U.S. Securities and Exchange Commission, SEC, and regulators worldwide reformed market oversight, imposing stricter regulations on program, trading, and stock index futures. Additionally, the circuit breaker mechanism was introduced, temporarily halting trading when market indices drop by a preset percentage to give market participants time to cool off, reducing the risk of panic selling. These measures helped lower the risk of future market crashes. Black Monday also heightened the demand for better risk management in financial markets. Corporations and investment institutions reevaluated the risks of leveraged trading and hedging strategies, strengthening risk control measures. Investors became more cautious, recognizing the dangers of stock market bubbles and excessive speculation. The crisis also highlighted the interconnectedness of global financial markets. With financial markets becoming more globalized, a stock market crash in one country can quickly spread to others, leading to a global crisis. Therefore, central banks and governments need to enhance cooperation when dealing with financial crises to address the volatility of global capital markets. In conclusion, the 1987 Black Monday crash was one of the most iconic stock market collapses in financial history, driven by a combination of market bubbles, program trading, and global economic uncertainty. While the crisis severely impacted stock markets, economies, and financial systems worldwide, it also prompted governments and financial institutions to rethink and reform market regulations. The market eventually stabilized, but the lessons from Black Monday continue to shape modern financial risk management and regulatory strategies.